Okay, everyone. Assalamu alaikum. Welcome to ACCA's Practice to Pass for the paper SBR. And I'm your trainer, Hamza Abdullah. Can you people all hear me properly? Can you people all hear me properly? Okay, yes, loud and clear. That's good enough. So let's start today's session. And we are going to discuss the paper SBR, which is one of the difficult papers of ACCA. And it has been recently introduced. The first attempt was September 2018 and the second was December 2018. So up till now we have total 2 pilot papers of this paper shared by ACCA, and one we have September 2018 exam and one we are having December 2018 exam. So there are total 4 exam papers which we can use as an understanding of what is required by the examiner and what is expected by the examiner. So there are some few changes as compared to the course of P2. Let me discuss those first. Basically, P2 exam has been changed to SBR. And the changes in the P2 exam to SBR is mainly in the area of consolidation, which has been changed from the calculation to the theoretical aspect of the area. So previously the question used to be of 35 marks purely based on calculation, and now it can be between 30 to 35 marks, but mainly based on the discursive element, the discussion on how the consolidation should be prepared and what treatment should have been done. The second change has been introduced by focusing more on some new areas. We call these new areas, although these were a bit of part of the course already. Like for example, if we talk about framework, the framework was already part of P2 exam, but that was not being tested by the examiner since long. So normally the students did not used to focus on this area. Similarly, the second area used to be the current issues one, which was basically an optional question, but now there is no optional question. So these 2 areas have been added into the course. Similarly, the third area which has been added into the course is the analysis and the interpretation. So 3 new areas have been added in the course and the consolidation strategy has been changed. So what I have planned in this session is to focus on these areas more as compared to the accounting standards. The ISs are pretty much same as they were in P2. They are the same in SBR as well. So we'll be focusing more on the new areas in the area of consolidation, which has changed as compared to the last P2. Now a brief profile about myself. My name is Hamza Abdullah and I'm the trainer for ACCA's paper FR and SBR. So these two are my major areas, and I've created a WhatsApp discussion group so you people can join this group for any discussion with each other and any discussion required with me. Okay. Adele is saying can't see what you are writing. Can everyone else see what I'm writing? Adele is saying that he cannot see what I'm writing. Okay, yes, everyone is saying yes. Okay, Adele, I think there's some problem from your side. If you close the session and join back again, that would probably help you. So about me, I'm an ACCA member. I have experience from Deloitte, Pakistan, and I've been teaching ACCA since last 10 years. And I've been produced multiple nationwide positions in different attempts, and I have historically produced pass rates above the global pass rates throughout my teaching career. And I've conducted multiple training sessions on IFRS, which have been officially conducted by ACCA and ICAP. ICAP is basically the Institute of Chartered Accountants of Pakistan. So here we have the WhatsApp link. A lot of people are asking it again. So this link is available in the PowerPoint presentation shared with you people. So you can simply click on that, copy paste onto that, and you can join the group easily. Still, if you have any problem, you can contact the admin. They will share you the link directly so that it's more easier for you to join this the WhatsApp group. Now let's start the discussion with the paper pattern. Basically, the exam has two sections, section A and section B. So there will be two questions in section A and there will be two questions in section B. In question number 1, we are going to have the area of consolidation merged with some accounting standards. The area of consolidation merged with some accounting standards. Just give me a minute. Okay, so in section number A, question number 1, we are going to have the area of consolidation, which is going to be merged with the accounting standards. So normally in question number 1, you can find part A with 3 different parts, and there's going to be a part B. Normally the first 2 parts are going to relate to the area of consolidation, and the remaining 2 areas would probably relate to the area of accounting standards. So this is how the question number 1 is going to be divided into the area of consolidation and the area of accounting standards. Similarly, in question number 2, there's going to be ethics merged with the accounting standards. But this time, this is going to be a single question with a heading. Like for example, heading number 1, and there's going to be a case. And then there's going to be heading number 2, and then there's going to be a case. And similarly, different headings with different cases. In every case, you are going to have to apply the accounting standard, and you have to apply the ethical challenges, identify the ethical challenges. Similarly, in heading number 2, you are going to do the same. You are going to apply the accounting standard, and then you are going to identify the ethical challenges. Same for the heading number 3 as well. So in this, there is not going to be a breakup between accounting standard and ethics. It is going to be a same scenario, and you have to apply the standard and along with the identification of the ethical challenges. But in question number 1, the areas are going to be divided. First 2 relating to the consolidation, and remaining 2 relating to the accounting standards. Now these 2 questions will add up to make a total 50 marks. There is no specific breakup of these 2 questions. So the first question may either be from 30 to 35 marks, and similarly the question 2 may be from 15 to 20 marks. Similarly, they can be of 25 as well, but this is not the practice which we have seen in the last 4 exams. So according to ACCA, the question can be of any breakup. But according to the past practice of the examiner, we have identified that question 1 is going to be between 30 to 35, and question number 2 is going to be between 15 to 20 marks. In question number 3, we are going to have the accounting standards, and we're going to have the area of analysis, which is going to be a total of 25 marks. Similarly, in question number 4, we are going to have the accounting standards, and we are going to have the current issues. Now these 2 areas plus the area of framework, these areas will actually be in question number 3 and question number 4. Maybe the first question relates to accounting standards and the analysis, and the second relates to accounting standards and the framework. Similarly, there is no specific combination for section B. So we can say there can be analysis, there can be current issues, there can be the framework. And similarly, the current issues can also be asked in section number A as well. So if the current issues is asked along with question number 1, so this is going to be a separate part, let's say part number C. So this is how the examiner is going to ask different areas of the SBR. But the ethics, consolidation, accounting standards, and analysis, these are the compulsory areas. These are the compulsory areas. Current issues may be there or may not be there. Framework may be there or may not be there. So these are not compulsory areas. But looking at the examiner's past practice in the recent 4 attempts, I think that examiner is going to involve the current issues or the framework somehow in the paper. It may it may relate to comparatively less marks, but it will be there. So you should be expecting that all of the areas will be there in the exam. So be prepared for everything, be prepared for the worst so that you can get the best. So this is the overall paper pattern for which we are preparing. Now let's discuss the capabilities required in the paper SBR. Now there are total 6 sections: Section A, Section B, Section C, Section D, Section E, and Section F. Section A relates to the fundamental ethical and professional principles, which means the area of ethics. Section B relates to the financial reporting framework. Section C relates to the financial performance of a range of entities, which means the accounting standards. Section D is the financial statements of the group of entities, which means the consolidation. Section E is interpreting the financial statements for different stakeholders, which we are going to call the analysis and the interpretation. And section F is going to be the current issues. So these are 6 important areas of the syllabus of SBR. Okay, so let me see some of your questions. Muhammad Rayan is saying how we can understand the examiner is asking about current issues. Muhammad Rayan, we are going to discuss this when we move towards the detail of the topic. Right now, we are having a bird's eye view of what the paper is all about and what is expected from you people and what is the expectation of the examiner. So we will be moving towards the worm's eye view of the individual topics, and then going into detail how to read the question, how to identify what the examiner wants, how to retain the knowledge, and then how to write the answer. These are all the parts that we're going to discuss. Meher, the analysis of ratios only. Basically, the analysis includes the ratios, the non-financial performance, the integrated reporting, the additional performance measures. Now, again, this is something that we're going to discuss in detail when we discuss the topic of the analysis. So this is not simply ratios. This includes the ratios, this includes the APMs, this includes the non-financial performance, and this includes the integrated reporting. So the IR framework is also a part of the analysis. So are we clear with the overall view of the paper, of the syllabus? Okay, so now let's discuss this into more detail. When we talk about fundamental ethical and professional principles, in this we have to discuss the professional behavior of an accountant, the ethical requirement from the accountants, and the consequences of the unethical behavior. That if the accountant is unethical, what are the consequences of that? Okay, Simran is a question. How many percentage of SBR will this session cover? We'll be moving towards that, Simran. Meng Heng Sao is asking that how to join the group. I think the admin will reply to you for this. Now, the second thing is the financial reporting framework. In the framework, we have to discuss the accounting framework itself, and then we have to discuss the strengths and weaknesses of that accounting framework. And in the accounting standards area, the section C, we have revenue recognition, which is IFRS 15. We have financial instruments, IFRS 9. We have leases, IFRS 16. We have employee benefits, IAS 19. We have income tax, IAS 12. We have share-based payments, IFRS 2. We have fair value measurement, IFRS 13. We have non-current assets, which includes IAS 16, 23, 40, 36, IFRS 5, all of them. Then we have provisions and contingencies, which is IAS 37. We have events after the reporting period, which is IAS 10. We have the reporting for SMEs, which is a separate accounting standard. And there are some other reporting issues as well. So all these are in the section C. So this is the largest area of the SBR exam. But this is something which is exactly the same as P2. So there's no change in this part of the area. And now in part D, we are going to have the group accounting. We are going to deal with the associate and the joint arrangements. And we are going to discuss the foreign transactions and the foreign entities. After this, we will be discussing the interpretation of the financial statements, which includes the APMs as well. So APMs is one of the major areas of the interpretation. And finally, we have the changes in the accounting regulations. So this is a bit of more detail of the course outline. Okay, Abdul Munaf is asking, can we expect a UK gap related question? Abdul Munaf, you should expect this if you are appearing in the UK based exam. If you are giving the international variant, then it cannot be asked. Simran is saying, sir, can you give example of accounting framework questions? Simran, we will be discussing this. Let me share the plan that we will be following. So this is our 4-day plan, day 1, day 2, day 3, and day 4. So in day 1, we'll be discussing the area of consolidation, which is the syllabus area D. In day 2, we'll be discussing the area of ethics, which is syllabus area A. In day 3, we'll be discussing the analysis and the interpretation, which is the syllabus area E. And in day 4, we are going to discuss the framework and the current issues, which is the syllabus area B and syllabus area F. So the only area left is going to be the syllabus area C, which relates to the accounting standards, which is the same as the paper P2. So this is the overall plan that we are going to follow. Kabir Bhatti is asking, sir, how can we use our prior knowledge of P2 in SBR now? To what extent? Basically, the knowledge of the accounting standards of P2 is completely relevant to SBR. But the area of consolidation is a bit different as compared to the P2 one. So that is from where we are going to start the today's session as well. Simran is saying, sir, is the double entry knowledge required in SBR? Yes, Simran, it is not exactly in every question, but obviously the knowledge is required for that. But whether we will be preparing the entries or not, that is something we will be discussing in the questions. Mohammad Rayan is saying, when will part C? Mohammad Rayan, actually part C, I have already conducted a lot of webinars on the part C one, so that is why I plan not to cover this in this webinar. But what I can do, I can share you the links of the previous webinars on the WhatsApp group so that you people can refer to those for the area of section C. Asad Aslam is saying, I have heard most of the questions are discussion based and computations are not making focus of SBR exam. Is that true? Yes, that is true, Asad Aslam. The examiner wants the discursive answers rather than the calculation based answers. Arbaz Hassan is saying, any shortcut for SBR? Well, Arbaz, there's no shortcut to education. You have to study, you have to gain the concepts, you have to apply them in the exam, and then you are going to pass the exam. Yes, Ogail, I can see your comment. You are saying very clear, sir. Can you see my comment? Yes, I can see. But actually, when the question is shown to me when I move towards the option of the question. So when I start discussing, your questions are recorded at the back end. I'm not able to see at that point of time, but I will be seeing them when I click on it. So you can send your messages and I will read them in a while every time. Okay. Yes, Kabir, admin will reply to you on this. So let's start from the financial statements of group of entities, which is consolidating different financial statements. Now, when we talk about the areas of consolidation, there are some basic areas and there are some advanced areas. There's some basic consolidation areas and there are some advanced consolidation areas. The basic one includes the purchase consideration. You should know how to incorporate the purchase consideration. You should know how to calculate the goodwill, which includes both the partial goodwill and the full goodwill and the negative goodwill as well. Similarly, you should be able to incorporate the fair value adjustments. You should be able to incorporate the intragroup tradings and the current account balances and any intragroup loan. So these are some basic consolidation areas which you should be aware of. Similarly, when we talk about advanced consolidation, you should be aware of step acquisition, where we acquire a subsidiary in different steps. You should be aware of disposal, and you should be aware of foreign subsidiary. And the impact of all these, you should be aware on the impact on the statement of financial position, the impact of these on the statement of comprehensive income, and the impact of these on the statement of cash flows. Yes, Harsh, we'll be discussing this. So this is a complete overview of the area of consolidation that we should be knowing. Now let's start the discussion from the purchase consideration. One thing which is very important for you people to understand, a lot of times people expect the prepare to pass webinar to cover the entire course, which is obviously not possible. So this is an overview of the topic. This is an overview of the topic and plus detailed focus on the practice. That is why it is called practice to pass. So we are not going to study everything in detail. We are going to revise it. We are going to have it in an overview, and then we'll be moving towards the pass exams so that you are aware that how this knowledge is to be applied. Mohammad Rayan is asking, sir, will you solve the exam standard questions or only explaining the concepts? Basically, Mohammad Rayan, my more focus is going to be on the practice, on the exam level questions, rather than discussing the concepts. The concepts people get from everywhere, but how to apply those in the exam is something which is very important. So now let's discuss the area of purchase consideration. So when we talk about purchase consideration, this is the consideration which we are going to pay to subsidiaries ex-shareholders. Who are ex-shareholders? Previous shareholders. So this is a transaction between the parent and the previous shareholders of the subsidiary. So when we acquire the subsidiary, we are going to debit the investment in subsidiary. This entry is from the individual financials point of view, and we are going to debit the goodwill from group's financial view, because in the individual financials of the parent recorded as an investment in subsidiary, and any investment which is recorded in the financials will ultimately be converted into the goodwill in the group financials, and we are going to credit the consideration that we have actually paid. So for example, if we have paid a cash consideration, we are going to credit the bank. If we have paid a share exchange, which means we have provided the consideration in the form of shares, we are going to credit the share capital and the share premium. If we have given the consideration in the form of loan notes, we are going to credit the loan notes. Debit is the same, the investment in subsidiary or the goodwill, and the credit is according to the case. So if we are giving cash, we are going to credit the bank. If we are giving shares, we are going to credit the share capital and the premium. If we are giving loan notes, we are going to credit the loan notes. If we are deferring the consideration, if we are giving the deferred consideration that an amount will be paid in later years, in that case, we are going to credit the deferred consideration as a liability. And there's one more thing, that when we record the deferred consideration, we record it at the present value. And whenever a transaction is recorded at its present value, it needs to be unwind. It needs to be unwinded. It needs to be compounded. So any liability which is calculated at the present value needs to be unwound at each year end. So these are some basic types of considerations that you would have studied in the F7 course, which is now known as FR, financial reporting course as well. But something which is new or more detailed in SBR are these two. That what if the payment is a contingent consideration which is in cash, or a contingent consideration which is in shares. So let's discuss this on the next slide. That what is a contingent consideration? Contingent consideration is a conditional consideration. This is a conditional consideration, a conditional payment, a payment that we are going to make if a certain condition is met. Now, if we are giving the contingent consideration in cash, like for example, we say we are going to give $2 per share if subsidiary reports a profit in 2 years. So if the subsidiary reports a profit in 2 years, we are going to give $2 per share. So now this if is a condition, and we are going to give what? $2 cash. So the entry that we are going to make is going to be the investment in subsidiary debit and the contingent consideration as a liability credit. At what value? The value is going to be the number of shares that we have acquired into $2. This is the amount that we are going to pay, plus, as this amount is going to be paid after 2 years, we need to convert this into the present value. So we are going to calculate the present value of the amount that we have calculated. Plus, as this is a contingent consideration, the question may say that there is a 20% chance of subsidiary reporting a profit. So this means that we should be taking amount plus present value plus 20%. So for example, if the number of share that we have acquired is $80 million, so the amount that we need to pay is going to be $160 million. And let's suppose the cost of capital is 10%. So we are going to convert it into the present value, which is going to be divided by 1.1 to the power 2. So what is the value going to be? Can someone tell me? 160 divided by 1.1 to the power 2. So it is going to be 132 approximately. Yes, thank you, Anwar Kareem, and then thank you, Farida. So this is going to be $132 million. I have rounded off to the $1,000,000. Now this is the present value of the payment that we may pay. And as there's a 20% chance of paying, we are going to multiply this by 20%. So the answer is going to be $26.4 million. So we are going to record this liability by $26.4 million. So this is how we are going to record the contingent consideration. And this is what is called the fair value of the contingent consideration. This is what is called the fair value of contingent consideration, Mohammad Rayan. The value that we have calculated is the fair value of contingent consideration. Now what will happen at the year end? This is something which we have made at year 0. Plus at the end of year 1, now what we are going to do? We are going to unwind the liability by 10%, which is going to be 2.64. So we are going to make an entry as the finance cost debit and the contingent consideration credit. So now every year we need to unwind the liability. Usman Qureshi saying, and we disclose the 80% in the notes. Yes, Usman, a disclosure will also be required for this to prescribe the detail of what liability is in actual on us. Now, apart from this, we also need to reassess the liability, because the chances that we have taken were 20%, they may have changed at the year end. They may have changed at the year end. Mira is asking that, so it is kind of a similar to deferred consideration. Yes, Mira, it is similar, except for this percentage. This percentage is not applied in case of a deferred consideration. This is going to be applied in case of a contingent consideration only. Yes, exactly. So now in case of contingent consideration, what we are doing, we are doing three impacts. Recording the contingent consideration at present value, less unwinding at each year end, plus we are reassessing the liability at each year end. So because in SBR, the examiner is going to expect you people writing down the elements in the theoretical impact. So these wordings are going to be required over there. That if a company has provided a contingent consideration to the previous shareholders of a subsidiary, we are going to say that the parent should recognize the contingent consideration at its present value and then unwind it at each year end and then reassess the liability at each year end also. And if the liability changes at the year end, this is going to be treated as a change in accounting estimate as per IAS 8. Abdullah Abdul Ghaffar is asking which IAS applies to this accounting of contingent consideration. Abdullah Ghaffar, this is as per IFRS 3. Because if we see as per IAS 37, this liability should only be disclosed in the financials and not recorded. But according to IFRS 3, any contingent consideration at the time of purchase of subsidiary should be recorded. Any contingent consideration at the time of purchase of subsidiary should be recorded as per IFRS 3. Exactly. Meng Hong Sao is correct. Now, what if Harsh is saying, can you explain again about the treatment of reassessment of the liability at year end? Basically, Harsh, we had used a 20% rate to calculate the liability. What if that rate changes at the year end? So we need to reassess, we need to recheck the percentage. It may be 30% at the second year end. So we are going to apply that prospectively as a change in accounting estimate. Meg, change in accounting estimate applies prospectively, not retrospectively. You have written retrospectively in this. Mira is saying year one, we unwind based on this. Yes, exactly, Mira. You are right. So now let's suppose, let me tell you this in a bit more detail because a lot of students are asking question onto this. That for example, this was the liability that we have calculated at the first year end. And now we have recorded a liability of 26.4 and we have unwinded it by 2.64. So now it is going to be 29.04. Now when we reassess the liability, let's suppose the liability increased to 31. So this movement is going to be called a change in the liability. And we are going to make an entry as the contingent consideration debit by 1.96 and the P&L debit by 1.96. So this is how we are going to treat the change in the accounting estimate. Abdullah Abdul Ghaffar is saying, I'm confused this contingent consideration with contingent settlement of IS 32. Basically, Abdullah Ghaffar, that is something else that you are discussing about contingent settlement of IS 32. that related to the callable and the puttable instruments in IES 32. This is not something that we are discussing right now. Okay, Simran is saying both debits. No, Simran, P&L debit, contingent consideration credit. This is debit and this is credit. Zen is saying, where did 80 million come? Zen, we have assumed that we have acquired 80 million shares of the subsidiary. Yes, Mira, you're right. Mohammed Shahab is saying that the difference will go to P&L. Yes, Mohammed Shahab. Okay, now something which is more important to discuss is what if the contingent consideration is to be paid in the form of shares? What if the contingent consideration is to be paid in the form of shares? Like, for example, we say that we are going to give you 2 shares per share acquired if the subsidiary reports a profit. What accounting is going to be done in this case? So in this case, we are going to debit the investment in subsidiary and we are going to credit the equity. This time it is not a liability because an obligation to provide shares is not a liability. The obligation to provide shares is not a liability. Instead, it is a part of equity. Now, by what amount are we going to recognize this? Let's suppose we had acquired 80 million shares of the subsidiary. So we are going to pay 2 shares, which means 160 million shares of the parent. And let's assume that the market value, of each share was $5 and there's a 20% chance of the condition to be met. So we are going to multiply this by $5 and multiply this by 20% chance. So 160 million shares that we have acquired into $5 per share into 20% chance of the condition to be met. So this is going to be again $160 million. So this is the amount by which we are going to record the investment in subsidiary and the equity. And the equity is not reassessed. The equity is never ever reassessed. So once we have recorded this entry and then we are not going to reassess the amount of the equity or the amount of the investment. So the liability is actually reassessed, but the equity is not going to be reassessed. Is it clear so far? Okay, that's good. Everyone is clear so far. Mohammed Shahab is saying market value will be at the date of promise, at the date of purchase. Yes, Akib, $5 is the share price of the parent. Thank you, Simran. Bilal Siddiqui is saying to repeat this. Bilal, you can recall this again from the recordings because everyone else is clear. So let's move forward because we will be short of time. Okay, now we are going to discuss the difference between the full goodwill and the partial goodwill. What is the difference between full and the partial goodwill? Partial goodwill is basically calculated as the cost. And for example, if we have acquired 80% of the shares, so we are going to write the cost of 80% of the shares. And then we are going to deduct the fair value of net assets acquired, which should also be the net assets of the company into 80%. So the goodwill that we have calculated also relates to the 80% of the subsidiary. So this goodwill relates to the parent only. But in case of full goodwill method, we write the cost of 80% of the shares and then we add in the fair value of NCI, which is the remaining shares held by the NCI, and we add their cost to the 100%. So that is why when we deduct the fair value of net assets, we are going to deduct the net assets by 100% again. So in this case, the goodwill that we are going to get is going to be the 100% of the goodwill of the subsidiary, which relates to both the parent and the NCI. Mohammed Amin is asking, sir, will you send the screenshots of all recordings? Mohammed Amin, I will share the written slides on the WhatsApp group so you can take it over there. Mohammed Rayan is saying, will the unwinding be recorded in parents group's retained earnings? Yes, Mohammed Rayan. Frederick is saying, let's speed up a bit. Okay, Frederick, you think I'm still slow because I'm thinking that I'm going too fast. Sakib, you can ask the question on the WhatsApp group because it is not possible for me to take every question. So the questions that are relating to the topic right now, I will be answering those and remaining to be referred to the WhatsApp group. Okay, Harsh is saying, so in partial goodwill, we use NCI's share of net assets, right? Yes, while calculating the NCI. So now there's one more thing that we need to understand. Now this was working number 2, goodwill. If we want to calculate the NCI, we are going to start the NCI at acquisition from the net assets at acquisition into the remaining 20% share of the NCI. And then we will be adding the share of profit of the NCI to calculate the value of NCI. But in case of full goodwill method, when we calculate the value of NCI, we started directly from the fair value of NCI and then we simply add the share of profit into that. So this is the second difference between the full and the partial goodwill. That in partial goodwill, the NCI started from its share in the net assets, and in the full goodwill, the NCI started from the fair value of NCI. Yes, Mohsin, this is the share in the post-acquisition profit. So now this was a quick recap of the basic consolidation areas. And now we'll be discussing from the first important area, which is the disposal of subsidiary. When we talk about the disposal of subsidiary, there are 4 possibilities: 1, 2, 3, and 4. Either we are going to completely dispose of a subsidiary. We had a 70% share in the subsidiary and now we have disposed of all of the shares. Or we may dispose of a subsidiary in such a form that we still hold a 10% of the investment. Or we may sell a subsidiary in such a form that we still retain it as an associate. Similarly, fourth is the case where we have disposed of only 10% of the shares of subsidiary and we have still retained the control. So in first 3 cases, the control is lost, and in the fourth case, the control is retained. Now what accounting is to be done, that in first 3 cases, when we have disposed of the shares 70%, 60%, or 40%, we would have received some cash. So the bank is going to be debited by the cash that we have received. Similarly, when the subsidiary has been disposed of, because we do not have control anymore, we need to de-recognize the subsidiary by de-recognizing the NCI, debiting the NCI, by de-recognizing the net assets, which is crediting the net assets, and by de-recognizing the goodwill, by crediting the goodwill. So these three impacts is going to de-recognize the subsidiary. Like when we dispose of a normal asset, what do? We debit the bank, we credit the asset, and we take the balancing figure to the P&L. So we are actually de-recognizing the asset over here. Similarly, we are de-recognizing the subsidiary over here by closing three of its accounts: the NCI, the net assets, and the goodwill. Now the balancing figure will again be taken to the P&L. P&L in case of income statement and retained earning in case of the balance sheet. So in all of these three cases, the amount that has been received will be debited in the bank. The subsidiary will be de-recognized by closing NCI, closing the net assets, closing the goodwill, and the balancing figure taken to the P&L. Now this is basically the entry for the first case. But what if we have held the 10% investment? In that case, what we are going to do is we are going to debit the investment as well, because there's an amount, there's a value which we have retained as well. So in the same entry, we are going to debit the investment also. Similarly, if it is the third case, what we are going to do is we are going to add an we are going to convert the investment into the investment in associate, and this is going to be debited by what amount? By the fair value of the investment in associate, or the fair value of the investment which is held. So if we are retaining some part of the investment, we are going to debit it as an investment or investment in associate. So this is how we are going to account for the case of disposal, and we're going to solve multiple questions for the disposal immediately after this slide. So a lot of questions that you people will have will be cleared over there as well. Now in case of the fourth case, from subsidiary to subsidiary, this entry cannot be made because we have retained the control in this case. So what we do is the shares that we have disposed of, the 10% one, we receive the cash, the bank, by the amount of sale proceeds, and the NCI, which was previously 30%, has increased to 40%. So we are going to increase the value of NCI by crediting the NCI. So the value of the NCI has actually increased, and the remaining balancing figure is going to be taken to the OCE. Now when we credit the NCI, by what amount the NCI is going to be credited? So what we are going to do, we are going to calculate the NCI at 30%, and then we are going to divide it by 30% to get the value of every single percent of NCI. We are going to divide the value of NCI by 30% to get the value of every single percent of the NCI, and then we are going to multiply it by the percentage that we have disposed of, multiplied by 10%, multiplied by 10%. So this is how we are going to get the value of the NCI by which it should be increased. Okay, so I'm repeating it once again. that we had 70% of the shares, which means 30% belong to the NCI, and now we have 60% of the shares, which means 40% belongs to the NCI. Now what is going to happen? We are going to calculate the NCI according to the 30%, and we are going to divide that NCI by 30% to get the value of every single percent of NCI. And when we multiply it by 10%, we are going to get the value of the 10% of the NCI. But there's one problem, that what if we had 100% of the shares? If we had 100% of the shares in subsidiary, and now we have disposed of, let's say, 10%, and now we have 90% left. So in this case, the value of NCI was previously 0, and the percentage of NCI was also 0. So can we follow this method in this case? The answer is no. So when we have 100% owned subsidiary, what we do is we are going to add the net assets and the goodwill, and then we are going to multiply it by the 10% of the shares that we have disposed of. This is how we are going to get the value of the NCI. Simran is saying that, so the value of NCI is the fair value of NCI. No, Simran, if you're talking about this NCI, this is the fair value of NCI plus the NCI's share of profit. This is the value which is going to be taken in this working. And the balancing figure will be taken to the other components of equity. OCE means other components of equity. OCE means other components of equity. Now that was a quick recap of the area of consolidation. Now we are going to solve 3 different questions relating to the disposal. One is by the name of Kuchin, which is specimen exam number 1. One is Doyle, which is specimen exam number 2. And then we're going to solve the question of banana, which is September 2018 exam. So up till now, we have total 4 exams of SBR. Out of that, 3 of them relates to the disposal. So let's open these questions. You people would have received the questions in the email. You people would have received the questions in the email. So you can download that, or you can ask the admin to support on how the questions are to be downloaded. And meanwhile, I'm also opening it. So we will be starting from the question by the name of Kuchin. You have 2 minutes to open up the question, and then we'll be starting. We have 2 minutes to open the question. Okay, now let's start to solve the question. This is by the name of Kuchin, where the examiner says, I'm moving towards the requirement. And in the requirement, the question has A, part 1, 2, 3, and part B. Exactly the way that we had discussed, and the marks are total in 30. So A, 1 and 2 are going to relate to the consolidation, and 3 and part B are going to relate to the accounting standards. Sidra is saying, can you please tell how to join WhatsApp group? I think a lot of people are having problem in joining the group. So what you can do is you can simply go and check my contact number. It's there on the first slide. This is my WhatsApp number. You can drop me an SMS and I will share you the link on the reply. So you can send me the message that you want the WhatsApp group link and I will reply to you on the WhatsApp group or the WhatsApp. So now let's continue with the requirement of the question. The question part A1 says, explain to the directors of Cochin with suitable workings how the goodwill should have been calculated. How the goodwill should have been calculated, which means the correct goodwill to be calculated on the acquisition of house and match, showing the adjustments which need to be made. Showing the adjustment that needs to be made means that you should be showing the double entries to correct the consolidated financials. Showing the adjustments which needs to be made to the consolidated financial statements to correct any errors by the finance director. So we need to prepare the adjustments and we need to calculate the correct goodwill. So let's move to this right part of the question. If we go from the start, the question says that the following group financial statements related to Kuchin Group. So the question has already prepared the group financials. And what does the question wants from us? The question wants to correct the errors, correct the mistakes that he has done. Okay, Bride is saying, please the number again. I'm sending my number to all of you in a personal message. So this is my number. You can contact me personally on the WhatsApp. Okay, so now we are reading the question. The question says that the acquisition of 70% of house on 1st June 20x6, 1st June 20x6, Kuchin acquired 70% of the equity interest of house. The purchase consideration comprised 20 million shares of $1 each of Kuchin at the date of acquisition. So we are giving 20 million of our own shares at the date of acquisition and a further 5 million shares on 31st December 20x7. So we will be giving further 5 million shares after 1.5 years of the acquisition. And these shares are to be given if house's net profit after taxation was at least $4 million. So this means there is a condition on these shares. So these shares are going to be called a contingent consideration. These are going to be called a contingent consideration in the form of shares. So we are giving 5 million shares if the condition is met. Yes, Muhammad Rayhan. The market price of Kuchin's shares on the date of acquisition was $2 per share, and that of House was $4.2 per share. And it is felt that there is a 20% chance of the profit target being met. There is a 20% chance of the target being met. So, how we are going to calculate the consideration? Let me open the PDF file again. Okay, so I have the question again in front of me. And the question was saying that we have acquired how much? 70% of the shares. And the purchase consideration was how much? 20 million shares. And we are going to give 5 million further shares if the 4 million target is met. And each share had a price of 2, with subsidiary share price having a price of 4.5 and 20% chance that the target would be met. So now, if we see those 20 million shares that we have already given are of $2. So this means that we have given a consideration of how much? $40 million. And we will be giving 5 million more shares of $2, but there is a chance of 20%. So what is going to be the value of this? This is going to be 2 million. So the consideration is going to be $42 million. 20 million shares that we are giving immediately, and 5 million shares that we will be giving if the target has been achieved. Harsh is saying, sir, we need to use the future share price to calculate the contingent consideration. No, Harsh, we are calculating the contingent consideration at the date of acquisition. So we need the price at the date of acquisition only. Because we are calculating the consideration at the date of acquisition, that is why the share price at the date of acquisition is the price which is relevant to us. Okay. So now the question says that in accounting for the acquisition of house, the finance director did not take into account the non-controlling interest in the goodwill calculation. So the director has forgotten to take the NCI. He determined that a bargain purchase of $8 million arose on the acquisition of house. Being the purchase price of 40 million, this means he has used this 40 but not the 2, less the fair value of the identifiable net assets of house acquired on 1st June 2026 of $48 million. This valuation was included in the group financials above. So in the financials, the director has used a value of negative $8 million. So he has calculated negative 8 how? The cost of 40 and the net assets of 48. So this is how a negative goodwill has been calculated of 8 million. So we are going to say that this is incorrect and we need to calculate the correct value. Now the question says that after the directors of Cochin discovered the error, they decided to measure the non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest in house was to be based upon quoted market price at acquisition. The quoted market price at acquisition was how much? 4.2. House had issued share capital of $1 each, totaling $13 million. So this means that the number of shares are also 13 million at 1st June 2026, and there has been no change in this amount since the acquisition. So if I use the Excel sheet to calculate the goodwill, I'm going to say that the cost of acquisition plus the fair value of NCI less the fair value of net assets acquired should be the goodwill. Now what is the cost of acquisition? 40 plus 2 million, which is 42. This is the cost of acquisition, and the fair value of NCI is equals to 13 million shares. 13 million shares into 4.2. So the sum is going to be 96.6. And the net assets acquired were actually how much? 48 million. So if we deduct 48 million, we're going to get a value of goodwill of 48.6. So this is the value of goodwill that should be recorded in the financial statements. The correct value that should be there. Okay. So there's one more thing that the 13 million shares actually belongs to the entire company, and parent has a 70% share. So NCI is going to have 30% of the shares of $4.2 each. So 13 million into 30% into 4.2. 13 million into 30% shares into 4.2 will give us the value of the NCI. Thank you, Meg and Mohammad Rayan. So now the correct goodwill has been calculated at 10.38. Now what should be the correcting entry? The correcting entry is going to be first removing the negative goodwill that the question has recorded. And the negative goodwill would have been recorded in the retained earnings as a gain. So we are going to debit the negative goodwill, and then we are going to debit the goodwill that we have calculated of 10.38. And what should be credited? The first credit is the equity of 2 million, which the question has not recorded. The question had recorded the consideration of only $40 million. So we had increased the value by 2 million. So the equity should be credited by 2 million. And then we should be recording the NCI by 16.38. So this is how we are going to balance the debit and the credit side by 18.38. So this is the correcting entry that should be recorded in the financials. So if I go back to the question, what was question's requirement? The question requirement was how the goodwill should have been calculated, and the question needs the explanation. So we need to explain that how the goodwill is calculated, and then we need to show the adjustments which were required to correct the errors. So now we are going to write the theoretical part of the answer. For that, I'm opening a Word file. Abdullah Mambu is saying, yeah, that webinars will be shared tomorrow, Abdullah, so that you can access them. Okay, so now I'm going to write the answer of question. This is pilot paper or the specimen paper 1. Question number 1 question. I'm writing the answer of part A1. So now I'm going to perform the discussion required in the exam, which is the most important area, because the students lack in the area of discussion. Yes, Mohammad Rayan, adjustment means passing entry. Now we're going to say that when calculating goodwill, an entity must include all types of consideration, including any contingent consideration. In case where the contingent consideration is being paid in the form of shares, an entity must calculate the value of shares by multiplying the share price at acquisition with the number of shares to be issued. So in case where the contingent consideration is being paid in the form of shares, an entity must calculate the value of shares at the date of acquisition. And should apply the chances or the expectation percentage to calculate the fair value of the contingent consideration. In case of Kuchin, the directors did not include the contingent consideration of $2 million. They have not included the contingent consideration of $2 million. Therefore, should prepare the following entry in the group accounts. So now we are telling the entry which is going to be the debit as the goodwill by $2 million, and we're going to credit the equity by $2 million. So this is how we have discussed the first error, specifying the general rule and then applying that onto the scenario. That what is the normal rule and how we are going to incorporate that in the financials. Yes, I will be sharing the Word file. Mohammed Rayan, in case of shares, we did not calculate the present value. In case of shares, we did not calculate the present value. Usman, we are not going to record remaining 80%. We are only recording the 20% impact, and the remaining values are going to be disclosed. Now we have answered the first part of the error in the question, which was the calculation of the purchase consideration. Now the second error was that the question did not take into account the non-controlling interest. This one did not take into account the non-controlling interest. So now we are going to write the answer on this, that while calculating goodwill, we can write further, while calculating full goodwill, an entity should add the fair value of NCI in the cost of acquisition paid by parent before deducting the net assets acquired. Now this we have defined the general rule, and now we are going to apply onto the scenario. In case of Kuchin, the finance director did not include the fair value of NCI, due to which the goodwill calculated was or resulted in a bargain purchase. So Kuchin should recognize the following entry for correction. And what entry is going to be? Goodwill debit, retained earnings debit, and the NCI credit. So goodwill is going to be debited by what amount? By 10.38 that we have calculated. Retained earning by the amount of 8, and this by 18.38. And I'm going to copy this as well. And I'm going to call this a working number 1. So this is a part of basically the workings, and the answer that we have written is this one. Now what mistake does the students do? They calculate the goodwill correctly, but they are unable to explain all these values in the explanation format. So giving the values or calculating the values is not sufficient enough to make you pass. You need to write the discursive part of the question, and that is very much easy. Just write the rule that you have studied in the class and apply it on the scenario. Write the rule and then apply it on the scenario. So this is how you are going to attempt the question in the exam. Is it clear so far to all of you? Mohammed Ryan is saying we should use professional English. Mohammed Ryan, you should use this type of English, layman English. Just be simple and easy to understand. Okay, let me correct this. This was 8.38 and this was 16.38. Because we have already debited the goodwill and equity previously. So one guy is saying, are we going to have a break anytime soon? We will be having a break approximately after 1.5 or 2 hours. So I think we will be taking a break in 10 to 15, 20 minutes. Okay, so now let's move on to the next part of the question, which is part 2, where the question says that explain with suitable calculations. Explain with suitable calculations. Just give me a minute. Okay, so now let's solve the part B, A2 of the question. The question is saying explain with suitable calculations how the gain or loss on the sale of niche should have been recorded in the group financial statements. So this time the question is not asking for any adjusting entries. So we are not required to make the correcting entries. We just need to tell how the gain or loss should have been recorded, which means what is the correct treatment of recording the gain or loss. So let's move up again. In fact, we haven't completed the part 1 yet. So this part you have to solve at your home. Solve this as a homework of this question. Because we are short of time, so we are continuing with the area of disposal of niche. This part. So the question says that Kuchin had purchased 80% interest in niche for $40 million on 1st January 2026 when the fair value of the identifiable net assets was $44 million. The partial goodwill method had been used to calculate the goodwill, and an impairment of $2 million had arisen in the year ended 31st December 2026. So we have acquired 80% of the shares for 40 million and the net assets was 44 and we were using the partial goodwill method. So if we calculate the goodwill of niche, and I'm calculating beside this, so the cost of acquisition was 40. There is no NCI. So the sum will also be 40. And the net assets were 44 into 80% because we are following the full partial goodwill method. So the net assets acquired was 35. This means the goodwill was actually $5 million, of which $2 million of the goodwill has been impaired. So the goodwill left is of $3 million. This is the value so far that the question has informed us. So we have acquired 80% interest for 40 and the net assets were 44 and we are using the partial goodwill and 2 million had impaired. The holding in niche was sold for $50 million on 31st December 2026. So we have sold the shares in niche for $50 million. And the carrying value of niche identifiable net assets other than goodwill was $60 million. So when we have sold the net assets, the entry should be bank debit, the amount that we have received, NCI debit, the net assets credit, and the goodwill credit. The balancing figure being the P&L, which can be on the credit or which can be on the debit hand side. So for how much have we sold it? We have sold it for $50 million. So bank should be debited by 50 when the net assets were 60. So the net assets should be credited by 60. Now the question further says Kuchin had carried the investment in niche at cost. The finance director calculated the gain arose of $2 million on the sale of niche in the group financial statements, being the sale proceeds of 50 million less 48 million being their share of the identifiable net assets, which is 80% of $60 million. And this was credited to the retained earnings. So the calculation done by the finance director is wrong because this is not the way of calculating the profit. And we calculate the profit as the net assets credit, the bank debit, the NCI, and the goodwill. So the amount of the goodwill was how much? $3 million. And the amount of NCI is going to be 20% of the net assets. Because we have acquired 80%, so remaining is 20%. So this means in actual, if we calculate the balancing figure, this is going to come on the debit side, which is going to be 1 million. So this is how the entry should have been prepared, resulting in a loss of $1 million. But the finance director has calculated a gain of $2 million, which is incorrect. Now, what is the question requirement? The question is saying explain with suitable calculations how the gain or loss should have been recorded. So if I write the answer into the Word file, I'm writing the answer to A part 2, and I'm going to say that in case of disposal of a subsidiary, its net assets are being derecognized from the group financial statements, and instead any remaining investment held is recognized the cash received, and the balancing figure is taken to profit and loss account. When derecognizing the subsidiary, the entity should derecognize its net assets, its goodwill, and the NCI. In case of Kuchin, the finance director has not taken account of the goodwill, which was $3 million, for which we can refer to working number 2. And we are going to copy the working number 2 that we have done over here. So this is working number 2. Let me take the entire answer down. So this is how we have written the working number 2 in the as a part of the workings. So the finance director has not taken account of the goodwill, which was $3 million, incorporating which the loss on disposal of niche would become $1 million. So this is how we were supposed to write down the answer of the question. So this is how we were supposed to calculate. Harsh is saying, where did you get 12 million from? And Simran is also asking the same question. Actually, the NCI is 20% of the net assets. I've calculated the NCI as the 20% of the net assets. And the goodwill that we have calculated is actually rounded off. So if I use the Excel sheet to take values to one decimal place, so this is going to be the sum of these two minus this. So the loss on disposal is actually 0.8. So let me correct this over here. This is 2.8 and this is 0.8, because Excel was actually rounding off the value, so that is why it was rounded off. Simran is saying that why we have not taken the fair value of NCI in this. Simran, we have not taken this because this is a partial goodwill method. This is not a full goodwill method. So because it is a partial goodwill method, that is why we have not taken the value of NCI and we have directly taken the value of the net assets. Are you getting this, Simran? Okay, good enough. So that was our first question relating to Kuchin. Now let's solve one more question relating to this, which is going to be our next question by the name of Doyle. Doyle is also one of the specimen exam questions. And in this, the question also relates to the area of disposal. So you people can open the question by the name of Doyle. Zan is saying, but sir, the fair value of NCI was given. Don't we incorporate the fair value of NCI and goodwill? Okay, basically, Zan, let me tell you, if I go back onto the question, this one, the question had mentioned that the partial goodwill method is going to be used. The partial goodwill method had been used. So this is why we are not taking the fair value of NCI, because the fair value of NCI will be taken in the full goodwill method and not the partial one. Exactly, Bride, you're right. So now I'm opening the question of Doyle. So let's go to the question's requirement, where the question says that in respect of the investment in Chandler, explain with suitable calculations how the goodwill should have been calculated. Show the adjustments which need to be made to the consolidated financial statements for this, as well as any implication of the recoverable amount calculated at 30th September to 2026. So this is again a pretty much similar question to the previous one. So you have to do it this on your own. We'll be solving the second part, where the question says discuss with suitable calculations how the investment in Doyle should be dealt within the consolidated financial statements for the year ended 30th September 2026. This is of 7 marks. So let's go to the question to read it down, which is actually this part of the question. In this, the question says that the disposal of 20% holding in Doyle, that on 1st October 20x4, he'll purchase 60% of the ordinary shares of Doyle. At this date, the fair value of Doyle's identifiable net assets was $510 million. The non-controlling interest at acquisition was measured at its fair value of $215 million. The goodwill arising on the acquisition of Doyle was $50 million and had not been impaired prior to the disposal date. So we have acquired 60% with the NCI value is 215 and the goodwill was 50 according to the question. Now the question says that on 1st April 2026, Hill disposed of 20% holding in the shares of Doyle. So we actually had 60% of them and now we have sold 20%, so we are left with 40%. So the subsidiary has now been converted into the associate. The subsidiary has now been converted into the associate, and we have disposed of these shares for a consideration of $140 million. At this date, the net assets of Doyle, excluding goodwill, were carried in the consolidated financial statements at $590 million. Now the question further says that from 1st April 20x6, which means from the date of disposal, Hill has the ability to appoint 2 of the 6 members, which means 1/3 of them. The fair value of 40% holding was $300 million at that date. So if I use the Excel to prepare the answer, first we are going to calculate the answer for Hill this time, Doyle for this time. So first I'm calculating the goodwill, the cost of acquisition, the fair value of NCI, less the fair value of net assets. So the cost of acquisition was how much? As the question given as the cost, the question said on 1st October he purchased 60% shares when the identifiable net assets were 510 and the NCI's fair value was 215. So we know 215, we know 510, and the goodwill we know that it was 50. So this means the question is not given as the cost of the acquisition. So we can assume that the goodwill calculated by the question is right. That is why it is not given us. Now the question further says that we have disposed of the 20% holding for a cash consideration of 140 million. So if I prepare the entry, I'm going to say bank debit by 140 million. The remaining investment in associate debit by 300 million. The NCI debit and the net assets credit, the goodwill credit, and the balancing figure is going to be the P&L. So we know the bank, we know the investment, and we know the net assets at the date of disposal were carried at 590. But we don't know the NCI, and we know the goodwill, it was 50. So now we do not know the value of the NCI and we do not know the value of the P&L. Now obviously we cannot find two balancing figures altogether. We cannot find two balancing figures. So how do we solve this question? The answer is that we need to calculate the NCI for this. If I prepare the working number 1 by the name of net assets, I'm going to say that the net assets at acquisition were how much? They were 510. And at balance sheet or at the date of disposal, the net assets were 590. So this means that the post acquisition profit was 590 minus 510, which was 80, in which parent had a share and NCI had a share of how much? Of 60/40. So NCI had a share of 40% of this. So the value of NCI was 32. And if I calculate working number 3 NCI, I'm going to say that the fair value of NCI was initially 215 and its share of profit is actually 32. So this means the value of NCI at the date of disposal is how much? 247. So this is the value by which we should be debiting the NCI. And now we are going to calculate the balancing figure as the sum of all these minus the sum of this to calculate the gain on disposal to be 47. So this is actually how we should be calculating the value of the goodwill, the gain on disposal, sorry. Is it clear to all of you? In this, we have calculated the post-acquisition profit to calculate the share of NCI, and then we have added the share of NCI to the fair value of NCI to get the final value, and then use this value to calculate the gain or loss on disposal. Simran is saying, so why you didn't divide the NCI by the number of NCI then multiplied by the NCI increase, like you taught just now? Basically, Simran, in this case, if you see, we had a subsidiary which has now become an associate. And the rules that I have taught you people in case of disposal, the one that you are asking, is actually that relates to the last case, this one. In this, we are going to divide the NCI by the NCI percentage into the percentage acquired. But the question is asking us the third point. This is the one which is being asked in the exam, for which we have studied this entry. So that is why we have prepared this entry in the current question. Are you getting the point, Simran? The value of NCI, the way you are asking, is calculated in the case 4, not in case of case 1, 2, or 3. Are you getting it, Simran? So we have done two different questions for the area of disposal. And is it okay if we are not taking a break for today's session? Because I think we are already short of time. The things that I planned to cover in detail are not yet done. We still have to do the step acquisition, the foreign subsidiary at least. These two areas are something which is important. So yes, everyone is saying no need of break. Thank you. So that's good enough. We're not taking the break. And now back to the slides. Now after the disposal, we have done these two questions and you have to try this one at your home and give me the feedback of how you're doing the question so that if there's any problem, we can discuss that. Now the area that we are going to discuss the next is going to be the piecemeal acquisition, which is also known as the step acquisition. This is the area of piecemeal acquisition, which is also known as the step acquisition. So now there are again 4 cases in case of piecemeal acquisition or the step acquisition. The first case is that we had 10% investment in a company and now we have acquired further 60% to make it a subsidiary of 70%. And the second case is that we had 10% shares and we have acquired 20% of them to make it 30%. And in the third case, we had an associate and now we acquired 40% shares to gain the control. So in the first 3 cases, we did not had the control. So this was from no control to control case. But in the fourth case, we already had a controlling interest of 60%. And now we have acquired further 10% to get it to 70%. So this is a case of control to control. So we need to understand the accounting for these 4 different type of the cases. So for the first 3 cases, the accounting rules are pretty much similar. That what we are going to do, the step acquisition actually has an assumption. The accounting of step acquisition is based on an assumption that the old investment the previous one, the 10%, the 10% or the 30% is sold and then repurchased at what value? At its fair value. So when the old investment is sold and repurchased at fair value, we say that we should be remeasuring the carrying amount of the old investment to its fair value, with any gain or loss taken to the P&L because it is a gain or loss on disposal. This is a gain or loss on disposal. So treating it as a gain or loss on disposal, we are going to treat this in the P&L. Bride is saying, please, to verify 10% to 70%, there is no control. Basically, there is no control to control. This is no control before acquisition, and now after further acquisition, we have the control. Similar cases for the third one as well. So in the first and third, we had no control. Now we had a control after acquiring the further shares. Okay. So now let's suppose that we had a carrying amount of $10 million of the old investment and the fair value was $12 million for the old investment. Now, according to the assumption, we are selling the old investment at its fair value. So the bank should be debited by 12. The investment should be credited by 10. And a gain on disposal should be taken by 2 million in the P&L. And again, according to the assumption, we have repurchased this investment at the fair value. So the entry should be bank credit by 12 and investment debit by 12. So now if we cancel off the entries, we say that the bank debit and the bank credit is being cancelled off. And similarly, investment debit by 12 and credit by 10 means a net entry of the investment debit by 2 million. The net entry is investment debit by 2 and the retained earning credit by 2 or the P&L credit by 2. So this is the net entry which is according to the assumption. So rather than making so many of the entries, what we say we would have simply brought the carrying amount to the fair value and recorded a gain of $2 million. So this is what you have to remember, that we need to remeasure the carrying amount of the old investment to its fair value, which means increasing 10 million to 12 million with any gain or loss taken to P&L. So this will automatically become the net entry that we have just prepared. Are you people getting this point? Okay, I'm explaining it again. Let me come again. That according to the assumption, we are selling the old investment at its fair value and then we are repurchasing it at the fair value. So if the carrying amount of the old investment was 10 and the fair value was 12, the assumption says that we have received 12 million on the disposal and the investment was by the amount of 10 million. So we had a gain of 2 million on the disposal. And when we have repurchased the investment, it was of 12 million fair value. So investment credit debit by 12 and the bank credit by 12. So the bank debit and the bank credit will automatically cancel off. The investment debit by 12 and investment credit by 10 will mean a net investment debit by 2 and the P&L credit by 2. So this is the net entry that is going to be made according to the assumption. So rather than making two long entries, we say this entry could have been made if we would have remeasured 10 million to 12 million. This is what is the first point that we need to remember. This is a type of a shortcut. Getting the point, Harsh? Abdullah has already got it. Good. So now this is a shortcut that simply remeasure the old investment to its fair value, with the gain or loss taken to P&L as a gain on disposal. Now, according to the assumption, when we have already disposed of the investment, so if there is any previously recognized gain or loss in OCI or OCE, which was actually unrealized so far, so according to the assumption, when we have sold the investment, that gain or loss has actually been realized. So we should be recording this gain to the retained earnings now. We should be recording this gain to the retained earnings now. So we say that any previously recognized gain or loss in OCI or OCE should be transferred to the retained earnings because now it is a realized gain or loss. Are you people getting this? Okay, Osman is saying, well, that means that the investment was held as available for sale in individual statement of financial position. Yes, Osman, you can say that. Exactly, Usman. Tawanda is saying, can you please repeat two? Yes, exactly, Bright, because the investment is disposed of. Zen is saying where OC comes in disposal. Okay, let me discuss the second point in detail. Let me discuss this in detail for you people. Although the objective of webinar is not to discuss the concepts or the logics, the objective is to discuss how to attempt these in the papers. So that is why I was trying to move on towards the exam as soon as possible. But if you need time to understand this, let's invest the time, no problem. Now let's suppose that we are talking about this 10%. So let me raise everything so that we can focus on what we are discussing. So now this is the case that we had 10% shares. Let's assume that we have bought them for $5 million or $7 million, and they are carrying right now at $10 million. And you know that the shares that we have acquired 10% fall under the IFRS 9. So let's suppose that we have classified these shares at the fair value through OCI. Let's assume that we have classified them at fair value through OCI. So this movement would have been taken to the OCI of $3 million. Now, the fair value was $12 million, and according to the assumption, we have sold the investment for 12 and repurchased at 12. We sold the investment at 12 and repurchased at 12. Simran is saying, what is the cost? 7 million, sir. Basically, Simran, we had acquired the 10% shares for a cost of 7 million. and now they are being carried at 10 million in the financials, and their fair value is 12 million, and they are being classified at fair value through OCI. So this means the gain of 3 million would have been taken to OCI. And now, according to the assumption, we have sold the investment. So when we have sold the investment, this means that this gain is now a realized gain and therefore should be transferred to the P&L. So that is why we are transferring this point, that any previously recognized gain or loss in OCI, if any, should be transferred to the retained earnings. Are you people getting this point now? Okay, that's good enough. Now the people have got this point. So we have discussed the first three cases. Now we are going to discuss the fourth case, where we already had a control, sorry. So if we already had 60% of the shares and now we are increasing to 70% of the shares, this is something similar to the disposal case that we have discussed in the previous topic. That the NCI was previously 40% and now the NCI is 30%. So what we're going to do, the cash that we have paid to acquire further shares will be credited from the bank, and the NCI will be debited because the NCI is reducing from 40% to 30%, and the balancing figure will be taken to the OC. Now again, by what amount the NCI is going to be debited? The NCI is going to be debited by the amount of NCI divided by 40%, the previous one, 40%, and we are going to multiply it by 10%. What is 10%? The shares that we have acquired. So NCI divided by 40% into 10% will give us the value of the NCI, by which amount the NCI should be increased. And the balancing figure is going to be the OCE. Yes, Simran, 10% is the decrease in the NCI. So this case is pretty much similar to the one that we have discussed in the disposal. Okay, so now this is something which we have already discussed in the previous slide, that we have to bring the carrying amount of the investment to its fair value, and any difference between the cost and the carrying amount will be transferred from the OCE to the retained earnings. So this is something which we have already discussed in the previous slide. Now let's solve one of the past papers questions by the name of Bravado. The question says that on 1st July 2007, Bravado acquired 6% of the ordinary shares of Mixed. Bravado had treated this investment as fair value through OCI. Available for sale is the old name of the fair value through OCI. This name was given in IAS 39, and after the implementation of IFRS 9, the name has changed. So this was treated as an investment in the fair value through OCI. in the financial statements to 31st May 2008, but had restated the investment at cost on Mixed becoming a subsidiary. So this means that the carrying amount is equal to the cost because we have restated the value back to the cost. Now, on 1st June 2008, Simran is saying to go back on the previous slide for a minute. Simran, this is the slide. Quickly take the snapshot. Okay. So now the question says that on 1st June 2008, Bravado acquired a further 64% shares, ordinary shares of Mixed and gained control of the company. So we had 6% previously and now we have acquired further 64%. So our holding is 70%. So previously it was a simple investment and now it is a subsidiary. The consideration for the acquisition was as follows. So on 1st June 2007, we acquired 6% shares for 10 million. So this is the cost and the carrying amount both. And 64% shares were acquired for 118 million. This is the cost of the new investment. Now the question says that on 1st June 2008, which was the date when the company became a subsidiary, the fair value of the equity interest in Mixed held by Bravado before the business combination was $15 million. So this is the fair value of the old investment. So this is the fair value of the old investment, which is $15 million. So we are going to bring the carrying amount to the fair value of 15, and the entry for this should be investment debit by 5 million and the P&L or the read-in earnings credit by 5 million. Investment debit by 5 million and the P&L credit by 5 million. The question further says that the fair value of the non-controlling interest in Mixed was 53 million. So when we are going to calculate the goodwill, the working to normally, so we are going to write the cost as 118 for the new investment plus 15 for the old investment. 118 and this 10 we have brought it to 15. So 118 plus 15 is going to be the cost, which is going to be 133. And then we are going to add the fair value of NCI, which was of 53 million. So the total would become 186. And then we are going to deduct the fair value of net assets to get the goodwill. So this is how we are going to calculate the goodwill in case of the Bravado question. Is it okay so far? Okay, Zen is saying, please tell why you added 118 and 15. Simran, the fair value of net assets are not given in this question up till now. That was given in the remaining part of the question. So that is why I have not written the fair value of net assets, but whenever you get to know, you can write and get the goodwill. Now Zen is asking why we have added 118 and 15. Zen, because what is the cost of the subsidiary? What is the cost of the subsidiary? The cost of 64% shares is 118, and the cost of 6% was increased from 10 to 15. So that is why we have added 15 and 118, because the cost according to the assumption is 15 for the old investment now. Meg, they were given as part of the remaining question, which I have not posted over here because a lot of question cannot be written in this PowerPoint. So that is why I've written only the value which was relevant right now. Okay, so let's solve another question, which is by the name of Robbie, where the question says that on 1st June 2009, Robbie acquired 5% of the ordinary shares of Zinc. Robbie had treated this investment at fair value through P&L. Robbie had treated this investment at fair value through P&L. So this means there is no value in the OCI in this case. In the financial statements to 31st May 2011. On 1st December 2011, Robbie acquired a further 55% of the ordinary shares of Zinc. So we already had 5% and now we have acquired another 55%. So the total is going to be 60%. So the investment is now converted into a subsidiary and gain control of the company. The consideration for the acquisition was as follows. So we have acquired 5% shares for 2 million and we've acquired 55% shares for 16 million. Now the question says that at 1st December 2011, which is the date when we got the control, the fair value of the equity interest in Zinc held by Robbie before the business combination was 5 million. So the fair value of the old investment is 5 million and the carrying value according to the question up till now was 2 million. So what we need is to increase the value by $3 million and making the entry as investment in subsidiary debit and the P&L credit. So we will be making the entry as investment in subsidiary debit and the P&L credit. Now the question further says that it is Robbie's policy to measure the non-controlling interest at fair value and this was 9 million. So when we calculate the goodwill, we need to add the cost and the fair value of NCI by 9. And then we are going to deduct the fair value of net assets to get the goodwill. Yes, Harsh, we need to add the fair value of the old investment in the goodwill working. Simran is saying, so what's the difference between carrying amount and the cost? How can cost change to the carrying amount? Simran, actually what happens is that when we have acquired the 5% shares, we are accounting for it under IFRS 9, where we carry the asset at its fair value. So maybe we have acquired an asset at a cost of, let's say, $10 million. And when the fair value changes to 12 million, we are going to change it to 12 million. So this is how the carrying amount and the cost may change. Bibi Farida is saying, is there any possibility that the cost will be reduced? Yes, Bibi Farida, it can be reduced. We will make an opposite entry by crediting the investment and debiting the P&L. Yes, exactly. So now when we calculate the cost in the calculation of goodwill, we're going to take 16, the value of the new investment, plus 5. the fair value of the old investment. So we are going to use 21 plus 9, which is going to be 30 million in the calculation of the goodwill. Yes, Usman, you're right. Basically, Simran, in case of IFRS 9, we carry the asset at its fair value. Na? We're going to carry the asset at its fair value. So if the fair value changes, we are going to change the carrying amount as well. Because the 5% shares were previously held under IFRS 9. Okay, so now let's continue with the next question. The next question is by the name of Mini. The question says that Mini acquired 14% interest in Putin, a public limited company, on 1st December 2010 for a cash consideration of $18 million. So Mini has acquired 14% shares, which means this is a simple investment for Mini. The investment was accounted for under IFRS 9 and was designated at fair value through OCI. So we have paid a cost of $18 million for this. Now on 1st June 2012, Mini acquired an additional 16% interest in Putin. So we have acquired additional 16%. Now we are having a 30% interest. This means that the investment has now been converted into an associate for a cash consideration of $27 million. So the cost paid for the new investment is 27 and achieved significant influence. So it is now an associate for us. The value of the original 14% investment on 1st June 2012 was $21 million. So its fair value is 21. So up till now, if we see, we need to increase the investment by how much? By $3 million. So the entry should be investment debit by 3 million and the P&L or the retained earnings credit by 3 million. And similarly, when we are going to calculate goodwill, we are going to use the cost of 27 plus the fair value of 21. So the cost is going to be in total 48. So if you see in every question of the piecemeal acquisition, we are doing the same thing. Yes, Simran, we are assuming that the cost and the carrying amount are the same right now. Now the question says that Putin made profit after tax of $20 million and $30 million for the years to 30th November 2011 and 30th November 2012. So these are the basic 2 years, 30th November 2011 and 30th November 2012. So the profit for this year was 20 and the profit for this year was 13. And at what date did this company become an associate for us? On 1st June 2012, which was exactly the mid of the year. So this means from an associate's perspective, we have a share in only $15 million. which is the division of 30. So 30 is going to be divided between 15 and 15 for the first 6 months and the last 6 months. So now, what share of profit do we have in 15 million? We have a share of profit of 30%, so it is going to be a profit of 4.5. Harsh is saying since it's 1st June, not 1st July. Let's count it, Harsh. The month of June, July, August, September, October, and November. It will make 6 months. Because we are counting from 1st June till 30th November. So the entire month of June, entire month of July, entire month of September, August, September, October, and November. So this is making 6 months. Are you people getting it? Bibi Farida? Bibi Farida is saying 7, Harsh is saying 5. Yes, so it's 6. Good. So we are going to take a profit of 4.5 million. Similarly, the question says that on 30th November 2012, Mini received a dividend from Putin of $2 million. So we have received a dividend of 2 million, which has been credited to other components of equity. This means the company has made an entry of bank debit by 2 million and other components of equity credit by 2 million. Although, what is the correct treatment of a dividend from associate? What is the correct entry for a dividend from associate? The correct entry is the bank debit and the investment in associate credit. So this was the correct entry and this was the incorrect entry. So now what is the correcting entry going to be? We are going to debit the OC and we are going to credit the investment in associate by $2 million. So this is how we are going to incorporate the values into the financials. Is it clear so far? Okay, the admin is asking for a feedback. So you people have 2 minutes to provide the feedback quickly. You have 2 minutes to provide the feedback of the session quickly. Okay, thank you everyone for the feedback. And now we are continuing with the session. And Zan Mansoor is saying that why not take the difference of 20 and 15 as the share of profit? Basically, Mansoor, during this period of time, what was our holding percentage? Our holding percentage was only 14%. So this was not an associate for us. If it is not an associate for us, why should we take the share of profit at that point of time? Because it was not an associate for us. That is why we cannot take the share of profit at that point of time. So that is why we have taken the share of profit when we had only 30% of the shares. So this is the time when we are taking the share of profit. Okay, Simran is saying that if the fair value through OCI, why do we record 3 million in PNL? Simran, because according to our assumption, your question is very right that when it says it's fair value through OCI, why are we taking to PNL? The answer is because according to the assumption, we have sold the investment. When we have sold the investment, this means the gain has now been realized. So that is why we are taking it to the retained earnings. Are you getting the point, Simran? Okay, that's good enough. And we are left with a very small period of time, so we are not continuing with the question with the further slides. So you have 4 minutes to discuss your questions. I'll be answering the questions during these 4 minutes because the next area that we are going to discuss is going to be the foreign subsidiary. And foreign subsidiary is one of the technical areas where I know you people are going to have a lot of questions. I will try to get into the detail of that topic on my own so that you people can have more knowledge and understanding of that topic. So we'll be continuing with the foreign subsidiary area in the next session. Simran is saying, I just want to thank you for your time and explanation. Most welcome, Simran. Mohammed Rayan is saying, so what about cash flow and joint arrangements? Rayan, we will be discussing the cash flows in tomorrow's session, but the area of joint arrangements will not be discussed in the webinar because that is comparatively a smaller area and less important as compared to the other areas that we'll be discussing. Hassan Salman is saying tips for how to prepare SBR. I've attempted once in September 18 and now I am taking it again. Okay, Hassan, basically SBR is all about your application to the knowledge that you're learning. If you're learning the knowledge very well, but you are not able to apply that on the question in the exam, you cannot pass. So what is more important is not to learn the rules, but how to apply the rules on a new scenario. This is something which needs to be learned. So passing SBR is gaining the concepts. Passing SBR is gaining the concepts. This is something which is the most important. Merullah is saying, what if the subsidiary issues shares during the year? Mer, actually, this is not a part of the course. In our course, the subsidiary is never going to issue shares during the year. Usman Qureshi is saying, sir, can you share summary of IFRS if possible? Okay, Usman, I'll be trying to share it on the WhatsApp group. Mira is saying, cannot wait to join for your next session. Thank you, Mira. Thank you so much. That is a compliment. Mer, again, percentage changes are also not a part of the course. Simran is saying, sir, what if someone has only 20% of SBR knowledge till now and he or she joins the webinar now? Is there any chance of passing? Simran, you should never lose your hopes. Do your best, give your best. I will be trying to cover as much course as possible, and uh, the remaining is can be left on the God. So try your best. I'll be trying my best. Let's prepare as much as we can. Do not think that whether it's possible or not, we have to make it possible. We have to make it possible. So this is something which is very important. Okay, Bride is saying I passed financial reporting because of you, sir. Oh, thank you so much, Bride. That was a very good compliment. Hassan Salman is saying, is the book reading necessary? No, Hassan Salman, you do not have time to read the book for March attempt. So right now, focus more on the revision, focus more on the past papers practice, and that is something which will be sufficient enough. Okay, so thank you everyone. The time's up for us. And Ogail is asking, are you saying you will be doing foreign subsidiary tomorrow? Yes, exactly. We will be doing the foreign subsidiary and the cash flow area tomorrow, and then we'll be continuing with the area of ethics. So that was the plan for tomorrow. Thank you, everyone. Take care and looking forward to meet you all tomorrow. Bye bye and Allah Hafiz.